and that I think is evident. For the first time, we've got nothing in the global market which is going our way. So the only problem was the currency, which is the dollar index, and whether dollar index was moving. Now the impact seems to be snowballing into other asset classes as well, which is crude is up, yields have shot up, dollar index is nearing 110, and correction in US equities, especially some of the tech stocks, it has started. So we are starting a brand new week, and there is definitely an element of anxiety, a little bit of give and take, and we are at a stage where for the moment right now it appears that local momentum, global setup, the mood and the momentum, everything has just faded away. Nobody expected this kind of a start to a brand new year. The general view was that markets would start normalizing and US markets will start topping out. But what we are staring at is a risk off moment, and money is moving into dollar denominated assets, and the unexpected spike in crude is something which we will have to deal with, I think, for at least for the day and for the week.
All right, but just to give you a wrap, a lot of this has happened in the week gone by, because talking about the Indian markets, then definitely Nifty 50 has seen a decline of over 500 points, and even the sharp fall in mid-cap and the small end of the market, they have declined over 6%. But other than that, there's a lot of cues that we are already watching out. We are in the midst of the earnings, because it was just on Friday that IT was able to lend some support to the markets. But other than that as well, the Nifty as well as Bank Nifty were seen to be declining and breaking their crucial support levels of 200-day moving average. That's a bit concerning. But just to give you a sectoral picture even more, is the public sector banks that were seen to be trending lower. The energy basket was also seen to be hitting its 11-month low. Nifty 50 did hit its 9th-month low. So is Nifty Bank, a 7-month low coming in for this particular index. It was just Nifty Realty as well as FMCG index that were seen to be lending some support from the lower levels. But on the flip side, IT did gain a 2% in the week gone by, all thanks to the TCS numbers. But Nikunj, how do you see the construct of the market, Indian market specifically, because we have breached the key support levels? Other than that, it's more of a fall that is coming in on the other pockets and even the broader markets. So are we in for some respite over there, or the picture is not looking that good in this morning?
See, for the week gone by, Nifty was down 2.5% and the small cap index was down 7%. I think this simple data point captures all the story. And for the small cap index, which was the performing index for 2024, which was up more than 20%, and Nifty was up 8%, it's the reversal which clearly in the broader market, in some of the rank mid-cap stocks, in some of the stocks which were patronized by HNI traders, by ultra HNI investors, that's the space where the unwinding clearly seems to be starting. So small cap is in bit of a disarray. The problem for the market is that suddenly the appetite to buy risk and to buy the stocks on decline seems to be missing. So from a market where everybody wanted to buy, they wanted to buy on decline, they wanted to buy high and sell higher, there seems to be a different approach. And the template is that small and mid-cap stocks were expensive. They're correcting largely because everybody wants to sell. Either they want to raise cash or they want to move to large and mid-cap stocks. So this week, because markets have fallen so hard, you will see a temporary respite. That could be called as a pre-budget rally, that could be called as a dead cat bounce. So I expect somewhere tomorrow, maybe later next week, you will see a bounce. But the bounce, I think, is a opportunity where small and mid-cap stocks are likely to be sold into rather than being bought into. Also, I was just thinking through it, that what is the tagline which in a sense will really incorporate the market for 2025? And here's something which I'll put on record, and I'll say that last 3 years, we have seen an era of low volatility and higher returns. I think we are now entering a phase, and every bull market enters into that kind of phase. Every market enters into that kind of phase. We are entering a phase of high volatility and low return. So the best way to approach this market is just keep your return expectations low. If you keep your return expectations low, and if you stick to what you know, I guess you will be able to navigate this kind of a fall. If you bought something because it's a tip in a lift, please take a hit and get out of that that stock. If you bought something where you can genuinely digest a 15, 20, 25% volatility, stick to it. It is not a market where you want to perhaps play blind. It's a market to play seen. If return expectations are low, if you know what you own, as long as valuations are reasonable on a 3-year window, I think this market, this correction will go away. But if your time frame is less than 3 months, if you bought because someone's told you anything, if you bought because you're chasing price, then this is not the best market to be in. That template of buy high and sell higher, or buy anything and just you'll make money, I think that era of the market is over. I'll say that line again. We're entering into a regime where the market has changed. From an era of low volatility and high return, you're entering into a time frame of low return and high volatility.
All right, so that's a change of an era that we are spotting at this point in time, and definitely we are in.
If you like this video, then like, share and subscribe to ET Now.